Good afternoon. It's 2 o'clock, so we thought we would get started. This is Shawn Neidorf at the Arizona Commerce Authority. I'm here with Mark Schultz from Snell and Wilmer. Also here with Chris Coons from the ACA, who's our tech guru, and also with our Associate Counsel, Mike Callis. We appreciate your joining us here today for this webinar to update everyone on what we've learned with the Treasury guidance that was released on October 19th. I want to tell you a little bit about the folks here who are going to be speaking and a little bit about the agenda. So the agenda is pretty simple. I'm going to give an overview of how we got here and some basics about the guidance. And Mark Schultz is going to go into much more lawyerly detail. That's because I am the SVP of research here at the Arizona Commerce Authority, and my background is in things like polling and economic and organizational sociology and finance reporting. In other words, I am not a lawyer. Mark, on the other hand, is a lawyer. He is a partner at Snell and Wilmer, where he oversees the tax credit finance group, the opportunity zones and opportunity funds industry group, and the renewable energy group. So he is living and dreaming opportunity zones full time these days. So we're going to give our presentations, and then we will be taking your questions. We would ask that you submit your questions through the Q&A function in the webinar. You should see an icon, depending on whether you're looking on a phone or a computer. It may be in a different place, but it should say Q&A. So if you would please use that to submit questions, we will have a healthy period at the end for questions and answers. I'm sorry?
There's also, on the phone only, the last slide.
What was that?
On the screen test.
Okay.
If they're on the phone only, they don't have this. Some people have dialed in.
If you are dialed in by phone only, you will.
I guess you won't see the slide.
I'm sorry, Chris and I were just getting confused with one another. If you are not able to use the Q&A function because you are on phone only, go ahead and email Chris Coons, CHRISK @azcommerce.com, and he'll watch for your questions. Again, that's CHRISK @azcommerce.com. We've got folks still signing on, so we're going to give them just about a minute or so, and then we will launch the webinar very, very soon. Thank you. More people, and that's fine. Thank you again for joining us. We took a slight pause to give folks a chance to log on, but I think we'll get going in the interest of respecting everybody's time. As I said before, I'm Shawn Neidorf. I'm the Senior Vice President for Research here at the Arizona Commerce Authority. I'll be speaking with you today along with Mark Schultz, a partner at Snell and Wilmer who's working on opportunity zones, We also have with us today Chris Kuntz and Mike Kellis from the Arizona Commerce Authority. Just in way of disclaimer, I want to just point out that while we hope that this will be a very informative presentation for all of you, this is not a substitute for legal or accounting advice. So if you are launching a fund, investing in a fund, liquidating an asset, looking to get involved in opportunity funds, in any way to be involved, we would encourage you to consult your attorney or your accountant or both. So with that, I'm going to get started and tell you my piece of the presentation today. So I'll start briefly with a little overview of the Arizona Commerce Authority. For the folks who may not be familiar, we are the state's economic development organization, and we have a very streamlined mission. It's essentially to strengthen the economy and facilitate the creation of quality jobs. And we do that with three strategies. One is to attract out-of-state and international companies to establish operations in Arizona. Another is to work with companies that are here to get bigger and keep their technology and their staff here as they develop. And the last is that we work with entrepreneurs to develop new technology here and have it be Arizona born and raised, so that Arizona benefits from and is able to share benefits with the rest of the world as 21st century technologies develop. This is a slightly fancier version of that information, which will show you that we have 10 strategies that we use to try to carry out those three missions around competitiveness, awareness, targeting high-value industries, including manufacturing, working on international trade and workforce and infrastructure issues, and of course, rural economic growth. We also have a little bit of information here at the bottom on our culture, and I want to call out two of those elements, and that would be our long-term vision and short-term action. This is a real set of principles we try to live by, and it's very much been what we've tried to do when it comes to maximizing the impact of opportunity zones and opportunity funds in Arizona. We really want to see this do as much for every part of the state as possible, and we've tried to be as proactive and timely as we can, and we will continue to do that. So I want to talk a little bit about how we got where we are. First of all, the law that created opportunity zones and opportunity funds was part of the 2017 tax law that passed at the end of the year. Can everyone hear us? I'm getting some folks suggesting that they can't. Yes. Okay, I'm seeing yes. I can hear you clearly. Thank you. I appreciate it because I got a little panic there for a moment. You might be able to tell we're using a new system here today. So again, this is a piece that was tucked into the 2017 tax law, and it's meant to do a few things. One is to move investments from passive to active investment, and two is to move those investments into communities that might otherwise be overlooked, places that either candidly have not recovered well from the recession or were not in good shape to start with. Places that have lower income and higher concentrations of poverty than the country as a whole. So specifically, to qualify as an opportunity zone, a census tract had to have 20% poverty, or it had to have a median family income that was no more than 80% of either the metro area or the state's income, whichever was higher. The law allowed governors to nominate 25% of the state's qualifying tracts for opportunity zone status, which means that investors can invest in those zones and receive tax benefits. Governor Ducey asked the Arizona Commerce Authority and our CEO, Sandra Watson, to collect recommendations from across the state and make recommendations to him about which tracts to nominate. So we did that. The decision was made that we would operate on, a principle of inclusion and a principle of proportionality. So we tried to balance those, and we said, okay, if the state gets 25% of its qualifying tracts, we're going to ask jurisdictions to represent or to recommend 25% of their qualifying tracts. So in Maricopa and Pima counties, communities with 10,000 or more people were asked to make their recommendations, and the county in turn spoke for small communities in unincorporated areas. In the rest of the counties, we asked the county to speak for the entirety of the county and recommend 25% of its qualifying tracts. Now, we also have tribal areas that have tracts, and we asked them if they had tracts that were centered on their property for them to make recommendations for their own areas. So we received those recommendations in. We had rounded up, so if a jurisdiction was entitled to recommend, say, 7.5 jurisdictions or 7.5 tracts, we let them recommend 8. And so we had a few more than we could take, which meant we had to make some cuts, not too many, fortunately, and we tried as much as we could to adhere to the recommendations of the community. And so that was our job, was to do that. And we submitted those in March, which was the first deadline. We could have asked for an extension, but Governor Ducey and Senator Watson were both clear that they wanted us to be among the first to submit in hopes that we would be the first to be approved. And in fact, that's what happened. We were among the first 9 states to be approved. And that has given us a little bit of a jump start as we've been planning for how to utilize this tool in Arizona. So our first role, as it shows here, was to identify those tracts, which we wrapped up in the spring. Our second role is to communicate information with shareholders, or excuse me, stakeholders around Arizona. And some of you may have been on a call we had on May 1st. We had a big event in September at ASU in collaboration with CDFA, the Council of Community Development Finance Agencies. So you may have been at either of those. We've put some information up on our website, which we'll continue to do, and this is our next effort to reach out to people. We've also been more informally working with our philanthropic community, which is interested in what can be done to advance nonprofit and other community benefits in opportunity zones with this new tool, and we've been working with our rural communities to be able to take maximal advantage of opportunity zones. Another of our roles is to connect people, and we're certainly working to do that too. It's been fairly informal so far. Stay tuned, because there's going to be some more formal efforts coming, and we're real excited about that, but still in process. And finally, we're going to be measuring. We need some metrics, we need some outcomes, we need to understand what the impact of this program is in Arizona. So stay tuned for that as well, because we are going to be collecting data and sharing data, and we want you all to be a part of that. It's not moving.
Switch back over.
On what?
And you click on the PowerPoint. Go all the way that way.
All right. Sorry, folks. Hold on. Haha, there we go. So just a little background. The state of Arizona has 1,526 census tracts. Now, a census tract is an administrative unit for the census. It's a geography meant to represent about 4,000 households. Think of it as kind of a small neighborhood. It can run anywhere from 2,500 people to 8,000, though, just simply because of variance in density. So in our rural communities, a single census tract can be rather very, very large and frankly very abstract shape looking, whereas in our urban communities, they'll be very small and rectangular or square. 671 tracts in the state met the criteria to be an opportunity zone, and of those we were able to nominate 168, all of which were approved by Treasury. I do want to point out there is at least one tract, approved opportunity zone tract in every county in Arizona. So this is a map that we have up on our website, and if you look at the lower left-hand corner, you can see that there's a live link, so when we put this up, you'll be able to use that. And when I show this map to people, I get different responses. People in urban areas look at the map and say, why are there so many of these, and why is there so much land in rural areas that is covered by an opportunity zone? And when people in rural communities look at it, they want to know why there are so many tracts in urban areas, even if they're smaller. Just a function of perspective. We did again shoot for proportionality on the basis of tracts, but you can see that in rural areas the tracts are just simply much, much larger. So this map, which links from our Opportunity Zone site, is really a just the facts Opportunity Zones only map. And if that's what you're looking for, this is the place to go. However, some people want a little more glitz, some more bells and whistles, and so we have something called the Arizona Assets Map. And this also has a link in the lower left corner. And this is a map that allows you to add up to 27 characteristics and take a look at what's going on in that community. This is Tucson, as you may be able to see. If you look down, let me see if I can do this. If you look down in the lower corner here where I'm moving the mouse, this is the airport in Tucson. This is the military base over here. If you look at these dashed lines here, these are railroad tracks, which particularly in some of our rural communities are really helpful to be able to show people where that rail access is. If you look at these things that look like little houses, they're actually little trains, and that shows where the light rail path is through Tucson. If you see these little orange and blue squares, they're actually little caps, like caps and gown caps, and those show you where the colleges and universities are. We have quite a few other facets that you can look at, but particularly if you're trying to understand what might be near an opportunity zone for your own investment potential, or candidly, if you're in economic development or you are a broker and you want to understand some things you can market along with your property, this is a good place to take a look. And that one's on our website, and again, the link is at the bottom left-hand corner there. So shifting a bit toward what are these tax benefits for opportunity funds? I should say, first of all, that the tax benefits accrue to the investor, not necessarily to the property owner, not to another group. It goes to the investor. And I also want to point out, because I've had to break people's hearts on this like 3 times in the last week, there is no social utility requirement to investing in an opportunity zone. It does not have to be a community benefit project. I've gotten a bunch of questions about that. Any project, with a few exceptions, can be done under this program. And so the tax benefits really break into 2 camps, and the first 3 are in the first camp. And that is, I apologize. My apologies for that. We forwarded people my phone line in case they had a problem, and apparently they're calling. So the first is that you get a deferral. If you have to have exited an investment, let's say you had $1 million capital gain in an investment, and you in turn, invest that money in an opportunity fund. Now you can create your own and go into someone else's, but this is what you've done with the money. You've realized it, you have $1 million in gain. You will not pay taxes on that capital gain until 2026, which really means you'll pay it in 2027, because it's the tax year of 2026 that it becomes live again for taxation purposes. If you are getting that money in and you have it in there for 5 years, by the time you hit the end of 2026, there will be a 10% reduction in the basis of what you're paying. So instead of paying on $1 million, you'd pay on $900,000. If you get 7 years in before the end of 2026, it's a 15% reduction. So you would pay on, $850,000 instead of $1 million. So that's the first benefit. And frankly, I think people get very hung up on this one because it's kind of complicated, but it's candidly the smaller benefit. The larger benefit is that that second investment that you've now made in this opportunity fund, if you hold that for 10 or more years, you will not pay capital gains on the benefit, on the gain that you have in that second investment. So that is really the thing that is really honestly the bigger one, but sometimes we get caught up because of the complexity of the first part. So when an opportunity fund, it has to be a fund, you can't invest directly, goes out to make an investment, has 3 options. It can buy stock in a company, it can buy a partnership interest in a company, or it can buy business property. The purchases have to be made for cash, and it can't be a so-called sin business. And you can see the explicitly ruled out sin businesses right there at the bottom of the page. So now, the U.S. Department of the Treasury, by statute, has particular responsibilities in administering this program. And one is that they have to tell us how you certify opportunity funds, and that's part of what came out in this guidance. They have to provide a quote-unquote reasonable period of time to reinvest returned capital. Hold on for that one. And they need to set up rules to prevent abuse. That is Treasury's role in carrying out this law. Now, we had been waiting for quite some time to see what Treasury was going to tell us, and finally, on October 19th, they began to release some of their initial guidance. These are proposed regulations and a revenue ruling. And as it says here, it answered some, but not all the key questions that investors, fund sponsors, landowners, and others were raising. The guidance was proposed. Treasury will be accepting comments on it. It has a hearing in January, but as long as you rely on the whole thing and you don't pick and choose, investors and others may rely in good faith on it now. So here is some of what it does. Now, I'm going to be candid that I'm going to hit the highlights and leave the nitty-grittier, gory details to Mark. So the first is that it clarified that only capital gains qualify for the tax benefits. There had been some question whether ordinary gains or other kinds of gains might qualify, and the answer is no. It's going to be capital gains only. The guidance also notes the taxpayer should use Form 8949, which is already existing, to let the IRS know that they plan to defer tax payment on the gain that they have realized and in turn invested in an opportunity fund. This is how they know you're not just running away and not paying. They also have released a draft of a form they're calling 8996, and that's the form that will be used to set up an opportunity fund and submit annual reporting. They started promising us this late spring, and we were hoping to get it over the summer, but it is finally here. So this is the form that you'll need to set up a fund. Now, and we've got some questions about this already, and I'm just going to talk about it generally, but there's a working capital safe harbor, and to talk about that, I need to talk a little bit about the timing rules that come with this. Part of the point of this law is to get investments made and made relatively quickly. It's to really sort of funnel this money into the funds and in turn into the zones very quickly. So investors who cash out of an investment and march their capital gains over to an opportunity fund have 180 days to get that money into the fund, so they don't have a very long period. The fund, in turn, has to deploy 90% of its capital into acceptable assets quickly because it gets assessed every 6 months. So those two time crunches really have a big impact on how funds do their planning. It's not like a venture capital fund that has commitments and then calls down capital as it needs it, because the investors themselves have to get the money into the fund very quickly, and the fund itself has to turn around and deploy it quickly. And this made a lot of people nervous. What kind of investments can you do with that kind of pressure on both sides? So there was a question of, would there be a ramp-up period? Would there be a grace period? And what Treasury came back with is what they're calling this working capital safe harbor. And it says that if you have capital that's going to be used in 31 months, you can exempt that from that 90% asset rule. But you can't just say, hey, we've got a plan for it. Sure, we do. You have to have a written plan for developing a property. You have to have a written development schedule, and you have to adhere to the plan and the schedule. And frankly, they have to be available if the IRS asks to see them. So there's still some complexity to this, which Mark's going to address, but it was a major question people were asking, and they did take it on. And there are a lot of references throughout the statute to substantially all this and substantially all that. It's a lot of requirements, and a lot of them pertain to investing in an opportunity zone business. They took a stab at defining exactly one of those, and it's the one that talks about how much of the property has to be in the zone, and they set the substantially all for tangible property at 70%. This means that if a business has most of its property, tangible property, in the zone, it doesn't have to be all of it. So they might have a bit of it that's outside. So maybe it's a manufacturing facility that has a small distribution center outside the zone. It provides some level of flexibility. So that is the first and only of these substantially all definitions that they tackled. There's also a rule that has to do with the requirement that properties that are not in original use be substantially improved. And there was a notation in the statute that an investor who's going to substantially improve a property has to spend essentially as much as they spent acquiring the property plus $1 in improving the property. And for properties that had functional buildings on it, that was causing a lot of dyspepsia. So there were questions about how to apply that. And Treasury's guidance clarified that yes, you do have to spend more than you spent acquiring the property on improvements. However, the baseline for that will be the value of the building, not the value of the total property of land plus building. So that lowers the threshold for rehabilitation. This will be important for people who want to rehab housing or community buildings or really almost anything that has a building on it. Those projects were going to be substantially more complicated without a clarification of this sort. But as Mark will address, it's a solution that comes with its own questions and curiosities. Another thing that Treasury did here was specify how you figure out whether you're meeting that 90% rule that says 90% of your assets have to be invested in qualified property. The question for a lot of people was 90% of what? Of tax basis, fair market value, what 90% of what number? And their clarification was that when you're counting up the value of an asset, you should use the value on the fund's financial statement. The fund doesn't have a financial statement. It should use the cost to the fund to acquire the asset. Simple, not so simple. Mark will talk a little bit more about that later. Altogether, the guidance gets us started. It gives investors and fund sponsors the paperwork and the details they need to just get going. The 31-month working capital safe harbor makes multi-year projects feasible. The ruling on how to calculate how much you have to spend on substantial improvement makes rehab projects more desirable. And knowing at least how much of the tangible property of a business has to be in the zone makes operating businesses a little bit easier to invest in, although there's still a lot of questions on that remain to be answered. There are, of course, lots of things we still want to hear about. One is that meaning of substantially all and the rest of the places that Treasury hasn't addressed yet. I'm going to skip the second one for right now because that's the 800-pound gorilla to me. There's the reasonable period to reinvest proceeds from a sale without penalty. There's what are the administrative rules going to be about what happens when a fund fails the 90% asset test. There's a fine associated with that, and a lot of people want to know how long do you pay the fine before you can get out of jail and tell them that you have met the assets test again. I shouldn't say jail. It's not jail. It's a fine, but the fine is assessed per month. And one of the things people are wondering is how soon can you show that you've met the rules so that you can stop paying the fine. There's also going to be reporting requirements, and we don't know what those are going to be for the funds yet. So going back up to that second point, and I use the exact language that Treasury used in their guidance, saying that guidance on this still needs to be developed, and that's transactions that may trigger the inclusion of gain that has been deferred. This is one of the issues that comes up, I think, probably most with operating businesses, although it could come up with other types of investments, and that's if a fund exits that investment in less than 10 years, does that trigger a tax issue for the investors in the fund? Do they miss out on making, say, their 5-year or their 7-year or their 10-year periods they need to hit for the tax benefits if that money comes back? And what happens if it doesn't get distributed to them? What happens if it gets reinvested? That's a question that has been kicked down the line to the next set of guidance, and I think that's going to be one of the most important pieces that everyone's waiting for. So now what? Where do we go from here? And what is ACA going to be doing about it? Well, first of all, we're going to continue to support everybody who's involved in this. Our investors, our landowners, our developers, our economic developers, our nonprofits and philanthropies that want to be involved in this, our rural communities, everybody who wants to be a part of this, we're here. We will continue sharing what we learn about the Treasury guidance. We will provide other direct support and assistance, and we will begin data collection so that we know what's going on and we're able to share that with you as well. We're going to continue to build expertise. We make sure that we share it with everybody. And one thing I want to point out is that all of the programs that ACA has, they can be combined with opportunity fund benefits. I am not the person to help you with that, but if you have questions about it, reach out to me and I will connect you to the folks who can. So these are the state tax credit and other programs that you're able to take advantage of, and we want you to keep that in mind as you are thinking about opportunity fund and opportunity zone investments. So I mentioned data collection. ACA is going to collect data about projects and funds, and we're going to share that with everyone. We want to make sure that we all have a working knowledge of how this program is benefiting the state. So look for that, it's coming, and we're going to need your help to make that work. We're going to need to know about funds and projects and investors who are looking around for things. We're pretty excited about this, and we want to collaborate with you. So like I said, that is very much an active project for us right now, and you will hear from us soon about it. We're here to help, as it says. This is my contact information. You are more than welcome to send me a message. I will respond as quickly as I can. I'm happy to point you to folks who has specific expertise about this, or to answer your questions and send you to maps and resources that would be helpful. So at this point, I'm going to remind you that if you have questions, we're going to take the questions at the end. We are looking at them as they come in, but I'm going to turn this over to Mark Schultz from Snell and Wilmer, who will give you a deeper dive into some of these issues that we've addressed, and also introduce them that frankly were just so technical I was not going to touch them as a non-lawyer with a stick. So thank you all. I appreciate your attention, and I'm going to literally change seats with Mark so that he can share his presentation with you.
Well, thank you, Sean, Mike, and Chris. I'm glad this wasn't a video conference, since my way over here, I had to start the camera. If you'd like. I spilled an iced tea all over myself in the car, but so thankfully it's not a video conference. But here we go. So, as Sean said, on October 19th, we received regulations, proposed regulations, and Treasury makes every point of kind of putting out there that this is really the first offer, and these are proposed regulations. So we have a comment period, and I'm sure there'll be many comments submitted, and we have answers to some questions, and we have more questions on some answers. So let's dig in. I'm going to start, instead of just going in what the regs say, because I'm not sure everybody knows. Because I'm not sure everybody knows enough about the program to just dig into the regs. I'm going to start from the basics and then add what the regs do. So I'm going to skip over. How much time do we have? Do we want to?
Almost an hour, so.
Okay, because we want to get 20 minutes for questions. Okay, if not more. Okay, good. So just a little bit, some of the basics on the program. This program was derived from a think tank that was created in Washington, D.C. by Sean Parker of Facebook and Napster, and to come up with solutions to the problem why certain zip codes around the country have a abundance of private capital and other zip codes have a dearth of private capital. And so no surprise, they came up with a incentive tool to incentivize investors to invest in these particular zip codes. And they hired some very good tax policy experts. And so no surprise, they came up with a incentive using the federal income tax code. So the predecessor to the Opportunity Zone program was called the Investment and Opportunity Act. It was created in 2015, 2016, didn't really go anywhere because we were in an election, but they had support of Senator Scott and Senator Booker and Congressman Teaberry and Congressman Kind. So they had bipartisan support in drafting this Investment and Opportunity Act. In February of 2017, we had some real momentum because we had quite a few co-sponsors. I think it was 86 or 96 co-sponsors, and a lot of bipartisan support. But again, Congress had a different agenda, and so this got shelved and revisited during the tax reform debate, which happened in late 2017. During that process, the Senate version, we had the House version, we had the Senate version. The House version had stripped out a lot of incentives, if I remember correctly, even the tax exemption on municipal bonds. But it was really the Senate version that drove the tax reform process And this Investment and Opportunity Act was adopted in the Senate version, and so the Senate version prevailed, and kudos to Senator Scott, who was sitting on the Senate Finance Committee and really shepherded these provisions into the tax reform process. And so the Tax Cut and Jobs Act passed in December 22nd of 2017. So all the states were under the time clock of having 90 days to submit the zones, and kudos for the state of Arizona to be one of the first states to submit within the 90-day time period. And I think it was 15 states submitted within 90 days, and the other 35 states needed the 30-day extension. So now we have the Opportunity Zone program here, and as you can see on this slide here, it's a process, a bunch of steps. We have, taxpayer sells an asset for a gain and makes an investment, a timely investment, we'll talk about what that means, into a fund, and then the fund deploys that capital into a real estate project or an operating business in an opportunity zone. The three benefits for the investor that we have here, and these are significant. So first one, we have a temporary deferral of what we call eligible gains. So this was something that we weren't sure. The title to the Opportunity Zone provisions say capital gain, but the body of the text just says the word gain. And one of the earlier versions of this legislation used the word capital gain throughout the body and of course the title. And so that word capital was removed. And we'll talk about what is an eligible gain, but in my opinion, Treasury and the IRS went very narrow on that, considering the fact that the word gain is in the body of the text. But what happens here is taxpayer sells an asset, and by investing in a fund gets to defer that gain that they would normally pay in that taxable year of the year of sale. And so that gets deferred out to become subject to tax on December 31st, 2026. The second benefit we have is when you are subject to tax on that deferral, there will be a partial reduction. We'll go into what that means, but a partial reduction of that gain. And then the third benefit is that if you hold your interest in the fund for at least 10 years, then to the extent that the value of that interest has appreciated, and you sell that interest, that growth on the investment will be tax-free. So those are the three benefits. The big question is what gains qualify from the investor standpoint, and so in the regulations they use the term eligible gains. Eligible gains, again, narrowly tailored to just capital gains, and so long-term, short-term capital gains, Section 1231 gains, so that's when you're using real estate in a trade or business, and then something called Section 1250 unrecaptured gains, so when real estate is sold to the extent that it was depreciated over a straight line basis, when individuals are reporting their gain, it's really kind of a recapture. It's a 25% income tax rate on the amount of depreciation that was taken straight line. What is not eligible is depreciation recapture, or at least the regulations don't say this, but this is just what how they're interpreting this, is that, if you sell inventory or you sell something that results in ordinary income on depreciation recapture, that would not be eligible. The other thing that the regulations do is it provides that your attributes from the year of sale are retained until the year that the deferred gain is recognized. And so there's some dispute on what this means. My view of this is if you have a short-term capital gain, it's going to remain a short-term capital gain in the year that you'll become subject to income tax. And so A lot of folks are thinking that it freezes your rates as well. I'm not sure that I would go that far. I would be planning for the potential for if there is an increase in rates, that you'd be paying at a higher rate when you have to report that when you're subject to income tax on the deferred gain. So if you have a short-term capital gain which is taxed at ordinary income tax rates, and the ordinary income tax rates go up in 2026, the year that you're going to include this in income tax, then I would at least factor that in your decision on investing, that the potential for that increase in tax rates could be a factor. Now, hopefully this is mitigated by the fact that there's a partial reduction in the amount of the capital gain, which we'll talk about. Then the question is, I sell an asset, when do I need to invest in the fund, and what are the requirements of that sale? And so I need to sell that asset to an unrelated person, so I couldn't sell that to my brother. The sale, in order to participate in this program, has to occur on or before December 31st, 2026. So there will be some investments in funds that can occur in the first half of 2027, because you have 180 days after the sale to invest in a fund. So I think you have until, if I count that out right, June 29th, 2027 to invest in a fund if you were to sell an asset on December 31st, 2026. There's an election that needs to be made, and Sean talked about that. I forgot the name of the number of the form, but Sean mentioned that before. And again, you have this 180-day period, which is super important. Let me just skip to. Let me just talk about real quickly about who can be a taxpayer and sell an asset, invest in a fund. And so here's a list that's provided in the regulations. It's pretty expansive. In fact, when the group, the think tank in DC that created this program, Economic Innovation Group, when they were estimating how much potential gains do we have that could be invested in this program, and originally I think they came up with a $2 or $3 million number, and then they didn't take into account the fact that we can have some C corporations, which are corporations that are tax-paying entities. So they pay tax at the corporation level, and then of course when they will distribute their profits as dividends, and then that's subject to a second level of tax at the shareholder level. So C corporations can participate in this program, and that, my understanding is that bumped up the estimate of potential capital that can be invested in this program from what, 2 or 3 trillion to 6 trillion. So again, it's a very expansive list here. Next slide, we'll talk about the 180-day period. So this is obviously super important. You know, how much time do you have to get into a fund? And so you've got 180 days from the sale, from your sale or exchange. The nice thing here that the regulations do is they say that you can have a single gain, but invest in multiple funds by making multiple elections. So the key thing is you still have to count out 180 days from the original sale. And they provided a special rule for pass-through entities, which we'll talk about. And this was a huge taxpayer favorable provision that they put in the regulations. So what kind of interest do you take in the fund when you invest in the fund? What does that mean? So it's clear you can't, by making a loan to the fund is not an eligible investment. So it has to be an equity investment in the fund. The fund can be a corporation, it could be a partnership, it could be a partnership for income tax purposes, which could be a limited liability company with multiple members, or a limited partnership. But it provides in the regulations that you can have preferred stock, and you can have a partnership with special allocations. So, you know, I could have a situation where I put in 5% of the capital, but allocated a higher percentage of the profits. Perhaps I have a preferred return that's higher than other investors' preferred return. So I'm going to receive more of the profits that way. There is some folks think that this could be a big deal for fund sponsors that are taking a carried interest. If the carried interest is treated as as capital and a capital gain on the back end, this could be a big deal for fund sponsors. We'll see how that one plays out, but I think that Treasury was leaning in that direction towards carried interest, perhaps enjoying the favorable treatment as being an eligible interest for purposes of this program, assuming that there's some type of capital invested as well. They do provide a provision that says that you can acquire that interest in the fund with debt proceeds. So unlike a 1031, a lot of folks ask me, why is this different than a 1031? And I'll give you an example. If I purchased Apple stock for $1 million and sold it for $3 million years later, I have a $2 million gain. First, I couldn't do a 1031. I couldn't acquire real estate after selling stock with a 1031 because it needs to be like kind, so that wouldn't work. But the second, perhaps I bought $1 million of real estate, sold it for $3 million, and I've got a $2 million gain, and I want to defer 100% of my $2 million gain. I'd have to buy $3 million of real estate, so I'd have to invest my $1 million of original basis in the new property. Also with the 1031, I'd have to escrow the proceeds. There's a very formal process, that I don't have here. So there's no escrow requirements. I sell my stock for $3 million. I can keep the original $1 million. And if I want to defer 100% of my $2 million gain, I invest $2 million in this fund. Now, if I want to spend the $2 million on something else, and I can get a bank loan within the 180 days and invest the proceeds into an opportunity fund, I can do that as well. The other thing that the regulations did was there was some dispute on whether if the opportunity fund were to take out debt proceeds under the tax code, there's something called inside basis and outside basis with a partnership. And so when I invest in a partnership, I get outside basis. Whatever cash I provide to the partnership and I take back the partnership interest, I have tax basis in that interest. And then whatever the partnership does with my money, if the partnership purchases an asset, then it has inside basis. So when debt proceeds are obtained by a partnership, partners get allocated to the extent that the debt is allocated to them. So if one of the partners were to guarantee the debt, if there's no guarantee, then it gets allocated fairly pro rata. You get tax basis, outside basis in debt. And so there was an issue, very technical issue. I won't go too far in detail, probably went more detail than I needed to already. But there was a technical issue that if debt was taken out by the partnership and folks were getting outside basis for that debt, were they deemed to be making a capital contribution with respect to this program, an investment with respect to this program, which would mean if they don't have a deferred gain associated with that, then they would have a investment in a fund not associated with a gain. So they would have a interest that perhaps if I put $100 into a fund and the fund takes out $900 of debt, and the $900 of debt is seen as also a capital contribution, then I have this bifurcated interest where $100 is associated with the deferred gain and $900 is not. So 10% of my interest enjoys the tax benefits, but 90% does not. So long story short, the IRS clarified that when a partnership takes out debt, that's not deemed to be an investment for purposes of this program. Here is a special rule that they provided, Treasury provided with respect to pass-through entities, and this is a very generous rule. Folks are pretty excited about this. So if you have a partnership that sells an asset for a gain, let's just say the partnership bought an asset for $100 and sells it for $1,000, we've got a $900 gain. The partnership can invest in the program and participate as an investor, up to $900. And the partnership would have a 180-day period starting from the sale or exchange. Well, the partnership just passes through the gain to the partners. It's a pass-through entity, same with an S corporation. And so what Treasury did here is they provided a very taxpayer-friendly provision here that pretty much says that to the extent that the partnership does not participate in this program with respect to a portion of that $900 of gain, the partners can participate in this program. So if the partnership were to choose to invest $300, the partners, to the extent that they're allocated that gain, in the aggregate can invest $600 into the program. So then the big issue is, well, when do you start the time clock, the 180-day time clock for the partners? Because the partners might not know whether the partnership invested in this program, and so why put the partners on the same 180-day clock as the partnership? And so what Treasury provided was that to the extent that the partnership does not participate in whatever portion they don't participate in, the partners can participate in the 180 days start on the last day of the partnership's taxable year, which is the day that they allocate that gain to the partner. So you get 180 days. So if the example would be if in January Sean and myself, we were partners in a partnership, and the partnership had a $900 a gain and participated in this program, invested in a fund tomorrow for $300, and there's $600 left. Sean and I would be able to take our pro rata portion of that $600 and invest in a fund, and our 180 days would start on December 31st. So we go 180 days from December 31st. Now, if we didn't want to take that 180 days starting on December 31st, we can make a special election to use the same 180 days that the partnership used. So again, there are quite a few folks out there that are worried that they missed the 180-day period to invest in a fund, and perhaps they might actually, they're 180 days because the sale that generated the gain was within a partnership. Perhaps they have not missed the window, and they'll be able to start their 180 days from December 31st of this year. So then the next question is, when, we talked about this gain deferral. You have to report that gain that you're deferring on the first to occur, and that's when you sell your interest in the opportunity fund, or December 31st, 2026. Here's something that a lot of folks don't realize, that the amount of gain that you do report, so whenever you report gain, you take what we call the amount realized minus your basis in the asset. And so at least with respect to the amount realized, you look at the lesser of the amount of gain that you're deferring, or the fair market value of the interest in the opportunity fund. So if I make a $2 million investment in an opportunity fund, and on December 31st, 2026, the value has significantly decreased, I probably will go out and get an appraisal so that my amount realized will be whatever my decreased value is in the investment fund. The other thing that they did in the regulations, which I thought was interesting, is if you were to sell your interest in the fund and dispose of your entire interest in the fund before December 31st, 2026, that again triggers your deferred gain. But what they do allow you to do is invest in a new opportunity fund, so that even though your gain was triggered, you get to defer it again. Now you only get to defer to December 31st, 2026. So if it's say it's 2022, and I were to sell my interest in the opportunity fund, dispose of the entire thing, that triggers my deferred gain. I'd be able to, on my $2 million deferral, I get hit with, tax in that 2022 year, but I could invest in the new opportunity fund, and then thereby probably it restarts my 10-year clock and the 10-year benefit, but then I get to keep deferring. But again, I still have that day of reckoning, which is going to be the December 31st, 2026 date. I'm going to go through this quickly. This is just a mechanism of how we get to the decrease of the gain, the deferred gain. And so, again, I said that normally when you, oh, I only have 10 minutes, so, okay, I'm going to skip over this piece here. And let's move to the 10-year benefit, okay? So a lot of folks were asking whether when I hold my interest in the fund for more than 10 years, am I forced to sell my interest in the fund at the 10-year mark? And the answer is no. There's a provision in the Opportunity Zone provisions in the code that says that the designations of the zones are only good for 10 years. No one knew what that meant. So Treasury shed some light on this, and they said that, pretty much it doesn't mean anything. But what they said was that this 10-year benefit, which is an election you make when you have a sale or exchange of your interest after 10 years, you get to make this election that gives you that 10-year benefit. And so what they did say is that there is a drop dead date for making that election, and that is December 31st, 2047. So you'd have to sell or exchange your interest before that date to be able to make that election. But that gives us a lot of runway. And so again, you're not forced to sell. You can keep riding the tax-free growth. That was what folks were worried, that after 10 years, the opportunity zone is no longer designated. So perhaps you can't keep riding tax-free growth after the 10-year mark, and that obviously commenced in 2018. So that was another very taxpayer-friendly provision that they provided in the regulations. I'm going to skip through this, keep skipping through here, and let's get down to what an opportunity fund is and how do you form one and what do you need to do. So there was the opportunity zone provisions don't provide too much other than say that the entity needs to be organized as a corporation or a partnership, and then have to go through a certification process and meet a 90% requirement, okay? So there was some dispute of whether the word organized as a corporation or partnership meant that you couldn't have a limited liability company. Under the tax code, when you say the word partnership, it means actually a partnership with more than one member, which can include a limited liability company with more than one member. And so they confirmed what we all thought, and that is you can have an LLC, but you have to have more than one member. There is a certification process, and they provided us with a draft form, Form 8996. This is a form that you attach to your tax return for the year that you want to be an opportunity fund, and you'll have to attach that form each year thereafter, because it also measures whether you meet the 90% requirement. But one of the things that they said, which is super important, and that is with respect to this 90% requirement, 90% of the assets have to be what's called opportunity zone property. We'll talk about that. It says in the opportunity zone provisions that you test it on the last day of the first 6-month period of the taxable year and on the last day of the taxable year. So one of the things that they clarified is that if you want to be an opportunity fund in the latter half of the year, your first testing date for meeting the 90% requirement is December 31st. So if you wanted to be an opportunity fund in May, you would have a testing date before the end of the year and on December 31st. And then perhaps in the second year, it'll be June 30th and December 31st, presuming you're a calendar year taxpayer. But so anyone that forms a fund, since we're in the latter half of the year, you're going to have a testing date on December 31st of this year. And that's important because, let's see, let me just go to, The 90% requirement is testing whether you have 90% opportunity zone property. So one of the things that's not opportunity zone property is cash and intangibles. So, so this is obviously very important for folks that are raising cash. If you've got too much cash on December 31st of this year, you've got a problem. And they came up with a, how do you measure the 90%? And they came up with this process that if you have a financial statement, you use the financial statement. If you don't have a financial statement, you use cost of an asset, cost of the assets. This is a big deal because cost means different things for different purposes, for tax, for accounting, and so we're going to need a lot more clarity. The regulations and the instructions with respect to this whole idea of an applicable financial statement don't sync up, so that's another issue. So I'm not sure that this was the best. In fact, the preamble to the regulations, the Treasury and the IRS even reach out and say, give us comments on this, and perhaps maybe we should have used adjusted income tax basis. So we'll see how that plays out. But let's talk about the 90% requirement. If you fail the 90% requirement, then you have a penalty. And so that obviously is it's a big deal to make sure you're compliant with the 90% requirement. I only have 4 minutes, so I'm running out of time here, and there's a lot to talk about. Opportunity zone property, it means there are two different approaches to an opportunity fund. One is the opportunity fund goes and purchases assets and does something with those assets, or the opportunity fund invests in a business, makes an equity investment in a business, and that business needs to be an opportunity zone business. Either way, there's this definition of opportunity zone business property. So if the fund goes and buys assets, in order for those assets to be opportunity zone property, they need to be opportunity zone business property. And if a fund goes and invests in an entity, then the entity needs to fulfill a bunch of requirements, and one of those requirements is that substantially all of its tangible property, owned or leased, is opportunity zone business property. So this definition of opportunity zone business property is really, really important, and I'm going to go right to that definition here and what the regulations did on this. So opportunity zone business property means tangible property used in a trade or business purchased from an unrelated person after December 31st, 2017, and the original use is in the opportunity zone. And this is a big deal. What is original use? And if you can't meet original use, then there is an alternative, which is the substantial improvement requirement. So just for folks in the real estate industry, if I go buy land in an opportunity zone this year, I've met, tangible property as long as it's an unrelated. I bought it from an unrelated person. Everything, I'm checking all the boxes, but can I be the original user of that property in the opportunity zone? The IRS would say no, because land is permanent. And so then, how do you make it opportunity zone business property? And so the IRS provided a rule that a lot of folks are looking at and trying to figure out the logic behind how they got to this result, although everybody likes the result. And so they came up with a rule and gave us a revenue ruling, and it pretty much says that if I buy a building, which if I buy the building, I have the underlying land. So if I buy a building and land, and I'm trying to measure this substantial, since I can't meet the original use requirement, I need to meet the substantial improvement requirement. And so what they say is that I can meet the substantial improvement requirement by only looking to the building. And so the substantial improvement requirement is a requirement that over any 30-month period after acquisition, and so that's any 30-month period after acquisition, I need to do something to the property that I add to the basis of the property by more than 100% of what I paid for the property. And so at least with respect to purchasing a building with land, what the IRS is saying is that you can look to the building, improve the building, add to more than 100% of the basis of the building, and we now have opportunity zone business property with respect to the land in the building. So again, this revenue ruling is causing a lot of heartburn on what this means for vacant property, because does that mean, in order to get to that particular conclusion, they say that you don't need to substantially improve the land. And so there will be a lot of articles, quite a bit of articles and discussions on exactly what this provision means and what the revenue ruling means with respect to vacant land. Sean, do I have more time to talk about?
I'll give you a couple minutes.
Okay.
How many questions do we have, Mike?
I haven't had the chance to go through these quite yet, but we do have a few that are rolling in.
So folks, if you have questions, please get them in, because when we mark it down, we'll start addressing them. So why don't we give you another few minutes?
Okay, sure. Let me.
I just want to make sure we have time to answer them.
Oh, should I?
Is it working?
Let's see if I can just
Go to the right, just go to the right. There we go.
Okay. So.
Click on it.
Okay, that's right.
Okay, good. So here's the gist is you got this 90% test, and the 90% test is at the fund level, and cash and intangibles do not qualify as opportunity zone property. So if you're raising cash and you're going to come up against one of these measurement dates, you've got a big, big problem. And so what Treasury did is they provided Sean talked about this, a safe harbor for the cash if you invest the cash in a lower tiered entity. And that lower tiered entity would have to be an opportunity zone business. So we call this the indirect investment approach. And so what happens is the fund then goes invest in the lower tiered business. That business, if that business is not newly formed, it needs to meet the requirements to be an opportunity zone business at the time that the equity is issued to the opportunity fund. And then it needs to, there's a provision that says that for substantially all of the holding period of the opportunity fund, it must remain an opportunity zone business. So what are the requirements to be an opportunity zone business? Let's go through the first. I mentioned this before, we call this a tangible property test. That substantially all your tangible property owned or leased by the taxpayer needs to be opportunity zone business property. So we just went through that definition of opportunity zone business property. The second requirement, which is a big one, and that is at least 50% of the income must be derived from the active conduct of a trade or business. Now, I'm going to flip here. First of all, the regulations define for the tangible property test that substantially all is 70%. So that was an ask of a bunch of our working groups, asked Treasury to use 70%, and they did, and that is terrific. The intangible property test, what they did is they added a situs requirement on that. So it used to just be, I'm sorry, the gross income test. I'll start with that one. So 50% of the income must be derived from the active conduct of a trade or business. They added in the opportunity zone. So that's something we don't know, and that's going to affect operating businesses. So that will be the subject of some further guidance. On the intangible test, a substantial portion of your intangible property must be used in the active conduct of a trade or business. And here they also added a situs requirement as well. And so a lot of folks are very perplexed on how you use intangible property in the opportunity zone. Does that mean that if I'm licensing the property outside the zone, does that qualify? And so there'll be a lot of discussion and a lot of comments with respect to how you meet this test as well. The most important one that they did is there was a requirement, a cash requirement at the opportunity zone business level, and it sounds worse than the 90% test, the 90-10 test, because there is a restriction that you have to have less than 5% of your property can be what we call cash, or what I call cash equivalents. Oh, let me move over here. Or cash type assets. So I have to make sure that I don't have too much cash at the opportunity zone business level, and it's less than 5% can be cash. Now this is where they provided this safe harbor, and it makes sense because we have the same requirement in the new market tax credit program, same language, same everything. And there is an exception in the statute for working capital, for reasonable amounts of working capital. So again, in the new market tax credit program, we have the same exception. And so what they did is they defined what reasonable amounts of working capital is for this purpose. And so they came up with the three three requirements. And so they basically said, if you designate in writing what you're going to do with that cash, so they specifically say you designate in writing that you're going to acquire, construct, or substantially improve tangible property in an opportunity zone. You provide a written schedule exactly how you're going to do that, when you're going to do that, and they give you 31 months to provide that schedule, to provide that you're going to spend that within a 31-month period. And then you need to substantially, what you do with that cash has to be substantially consistent with this written plan. So they provide this. The question then is, how specific this plan needs to be. Can you merely just say that I'm going to take this $10 million of cash and within 6 months I'm going to buy tangible property in any opportunity zone, and then within another 25 months I will have developed the property and improved the property? And so I would say the answer is no. There's an example in the regulations where they take this cash, they have this written plan that says within 1 month I'm going to purchase this property, and then within 30 more months I'm going to develop this property. And so that's the example they use in the regulations. So I would treat this as you need to have some type of specified plan, specified property, specified timeline. That's how I would treat this. And this will be an area that Treasury will weigh in on.
All right, did you have one last thing you wanted to say, Mike, because we have to?
I think for right now we can move to questions. I'm pretty sure that some of these slides will come into play with these questions.
Mark, before we see the questions, because I got a couple that came into me directly before we started.
Sure.
And they were really about how would the philanthropic and nonprofit community use this. And I know we've talked about a nonprofit could get a facility built through an opportunity fund, lease it for 10 years, and purchase it at the end of 10 years, thereby returning capital to the investors. But there's some other options. Can you talk about some of those other options?
Sure. So the opportunity fund, so obviously with a nonprofit, the issue is there's no equity, right, to issue to an opportunity fund. So there are two different structures that I see that where this could be used involving nonprofits. Again, that is where the opportunity fund owns land that it leases to a nonprofit, and perhaps it's a long-term lease and the nonprofit has an option to purchase after 10 years. So that would be one structure. The other could be a joint venture with a nonprofit. So a joint venture, perhaps you see this in the healthcare area where we have these, hospital joint ventures with physicians. And so you can have a situation where the nonprofit is one of the owners, one of the members of an LLC, and the opportunity fund is the other member. So that would be possible as well. There is nothing in these provisions that require social impact investing or community impact investing. But what has come to light in the last week is a potential to force impact investing and social impact investing. And that is because debt is not treated as a separate investment for purposes of this program, which is a good thing, and because interest rates are only going up, not going down on commercial financing. So there are some nonprofits that have, obviously community impact, social impact missions. And so perhaps what they can do is they can drive community impact investing by providing, credit to some of these opportunity funds with restrictions on what the opportunity funds do with respect to the debt proceeds, right? And so by providing favorable interest rates on a loan to an opportunity fund or opportunity zone business, you can mandate what they do. And perhaps if you're going to build a multifamily building, then you would be required to have a couple floors of affordable housing or something like that.
And in exchange for that, the fund would get a lower interest rate. Philanthropy than it would get from.
Exactly. So that is something, and I've actually talked to some people around the country, and they've liked this idea. And talked to someone today actually who said that they said the same thing a week ago to a nonprofit.
Okay. So what have we got in terms of questions, Mike?
There's quite a range of questions that have come in. So I'll start maybe with some for Sean. What's the role of cities, and specifically with regard to economic development practitioners or others who are operating from the city's perspective?
Well, certainly I think it's helpful for them to have conversations with their property owners, the current owners in the zones, and see what their plans are. Make sure they're aware of this. They may find that they want to have an operating business on there. They may want to lease the property. They may want to sell the property, and being aware of that is helpful. You know, we're talking, and this is perhaps more relevant in our rural communities, but if you have property that you think is well suited for development in the zones and it's not zoned or entitled yet, get it zoned and entitled. If you have zoning regulations that are in conflict with one another that will slow down a project, clean them up. You know, get into those conversations with your city attorney, with your city council. If you have that kind of thing that's going to stop people from knowing what they can do, it's going to make it hard to draw that investment. We are going to be collecting information about projects that are available and helping to share that. So I would say at this point it's time to do a lot of information gathering and talking with the brokers and really knowing what properties are available for what uses and thinking about where that fits into your general plan. And, you know, beginning to market those things and working collaboratively. And again, we've got some things coming on that. It's just not ready for prime time yet.
Wonderful, thank you. And then Mark, maybe one for you. This is with regard to, I think we have a lot of real estate businesses participating today. When it comes to real estate businesses and the requirement that they be in the active trader business within the opportunity zone, so let's say there's a landlord and he's managing his property, how exactly is the active trader business designated and what's the analysis and so forth?
So that is, I actually have put that in a slide here. So that is an issue. So one of the requirements, requirements here is the gross income test. So 50% of the income must be derived from the active conduct of a trader business in the opportunity zone. So that situs requirement does not seem to be problematic for real estate, but the definition of active is. And we have the same requirement in the new market tax credit program, and that is met, the word active is met by just having revenue within 3 years of, if I remember correctly, it's 3 years of the investment. But in other programs where they also use the same exact definition, active conduct of a trader business, same exact terms, active conduct of a trader business, they've used that to mean you have to have a meaningful participation in the management of the business. And I'm trying to remember, I think it's the DC Enterprise Zone program, where they actually, Treasury issued a FAQ and said that if you are triple net leasing, I think it's, if I remember correctly, it's an example, and it involves one property, one tenant, and a triple net lease, and they said that that was not the active conduct of a trader business. And so this was something that most comment letters to Treasury that were real estate focused asked for clarification here, and Treasury did not provide us with that clarification. So this is an open issue that hopefully Treasury will give us an FAQ and tell us what they mean here.
I have a couple questions here with regard to additions to the existing opportunity zones. Will there be an opportunity to add to the existing opportunity zones, or can we add land parcels to the opportunity zones? Maybe for you, Sean.
Well, at the immediate moment, no. The zones, the way the text and the statute is written, they were locked in for 10 years. There's no ability to change them. Is it possible that someone will write an addendum, will write an additional bill to say, hey, we should be able to add zones? Yes. Personally, I don't know that we would see that until we see some success from the program as it's written now that would justify opening this up to more communities and more tracts. But it is technically possible that someone could write a bill at any point if it gains enough votes in Congress and gets signed by the president, then we could have some more tracts. But as the statute's written, we don't have that capacity.
I agree. I think, but I do think that eventually, if we get some momentum, there will be enough votes there, because I think each state has 2 or 3 particular areas that are upset that they didn't get their census tracts in because there was only a limit. So, and presumably they're in different districts, and so that probably a vote right there. You know, so we probably can count up 200 to 300 votes potentially in the House of Representatives that we might be able to get with respect to adding on to the 11% of the census tracts that qualify for this program.
We have another question with regard to leases within Opportunity Zone properties. One references GIPLETs. The other is with regard to tribal properties, how they lease their properties. Mark, do you have any clarity with regard to how leases would operate?
Well, leasing, the issue with leasing is it's a structural issue with the Opportunity Zone statute here. The definition of Opportunity Zone business property specifically says it needs to be acquired by purchase. So if I lease tangible property, which is what real estate is, I can never meet that definition of Opportunity Zone business property. Structurally cannot meet it. We would need congressional action to change the definition of Opportunity Zone business property, unless it's a capital lease, which is really kind of, it's structured as a lease, but you're really the tax owner. And so the issue then is, how do you measure the lease? You know, you've got this 90% test at the Opportunity Fund level. We've got a 70% test at the Opportunity Zone business level. And so the question is my understanding, I'm not a GAAP accountant, but my understanding under GAAP, a lease is an asset. And so it would be measured, but it would be in the denominator, but not the numerator on both the 90% test and the 70% test. Perhaps under the cost approach, it would not be anywhere because there's no cost in a lease, but we don't know how you define the term cost. The better approach would have been to use income tax basis, because there's certainty with respect to the lease. I don't have an income tax basis in the lease, so it would be a zero numerator, zero denominator. It would not affect me. So hopefully we'll see. They didn't address leasing whatsoever, and so hopefully Treasury will address this in the second round, and we'll get some clarity, because if I remember correctly, tribal land, I think of the 8,700 census tracts, maybe 800, or if not maybe more, are on tribal land. And then you also have this issue with respect to municipalities and state-owned land, where folks are thinking of economic development opportunities by leasing that land. So this is a real issue, systemic issue that will, my suspicion is this will get resolved.
I can jump in for just a moment. We appreciate your questions, and we'll keep answering them, but we've got a few of our own. So we're going to send them out to you, because we'd really appreciate hearing your feedback so that we can continue to be of assistance around opportunity zones and opportunity funds going forward. So if you see those, if you would be so kind as to respond to the poll, we would very much appreciate it. So what else do you have for us, Mike?
Another question that comes up frequently is with regard to the role of financing both the opportunity funds themselves and then also the Opportunity Zone businesses. Do they have to be all cash? What's the role of debt? And specifically, maybe also touch on the role of taxable versus tax-exempt bonds in some of these financing opportunities.
Well, we know that debt is not seen as a separate investment from the taxpayer's perspective, so that's a good thing. So you don't have some type of bifurcated investment where some of it gets tax benefits and some of it does not. So that's a good thing. So I would suspect that every deal is going to have a debt component in the capital stack. And in terms of tax-exempt bond financing, a lot of federal incentive programs will provide a list of other incentives that cannot be used with that incentive, and oftentimes you see tax-exempt bond financing because, you know, especially with some of the tax credits, and so because they don't want double dipping, and this provision, the Opportunity Zone provisions have no prohibitions on other incentives.
Great. What about, maybe just sticking with this theme of investments, we've gotten a couple of questions with regard to whether there's a minimum amount of investment required in an Opportunity Zone fund.
No minimum amount. I think there's a practical minimum, and that is because you're really looking at a two-tiered structure, because the reasonable working capital safe harbor is at the lower tier. So you've got your fund and you've got a lower tiered entity. You know, the startup costs are a little bit higher than originally suspected. And so, you know, if you're setting up a fund, I just think it would be very hard to incur all these costs and the compliance costs that are involved. And we didn't even, I could have gone on for another hour and a half on these regulations and some of the other issues with the regulations and some of the other things that the regulations state. So I would just think from a practical standpoint, I would think that you'd want to do a deal that's at least $3 million at a bare minimum to use this program. That's not to say that there will be funds that you can invest in or funds that will invest in your business at a smaller amount. But if you're trying to do the fund and the, you know, and the lower tiered entity and keep it in some type of captive structure, I really think that you need a $3 million minimum, and that's just from a practical standpoint.
We have just 3 or 4 minutes left. There seems to be a general interest in receiving, I'll just tell this to Sean and maybe Chris, there's a general interest in receiving copies of presentations that have been presented today. So to the extent that we can share those, it looks like that will be beneficial for folks.
We're going to make those available.
Okay. And then also with going back to this question regarding building and the value of a building, the value of the land, the value of vacant land, is there any kind of proportionality requirement, or what's the analysis when it comes to, let's say you have a tiny house sitting on 100 acres, or let's say that you have an expensive building that's sitting on a small piece of land. To what extent can some of those valuation attempts be supported or challenged, so on and so forth?
So the revenue ruling deals with a situation where you have the land was worth, let's just say the purchase price was $10 million, 60% was allocated to the land and 40% to the building. And so so the revenue ruling said that if you improve the building by putting in more than $4 million, I'm making up these numbers, the proportion is what was in the revenue ruling. And so if you spend more than $4 million improving the building, then both the building and the land are opportunity zone business property. So I would not go more than or less than 40% on the building. I would not do 90-10. I would stick within what we have on the revenue ruling. And then you have to use, no matter what you do, you need to be using these assets in a trader business. So that is a requirement. It can't be just held for investment. So you have to do something that where you're operating a trader business with respect to these properties. So if you have a big piece of land and small building, even if you were to try to do a 90-10 structure or a 95-5, you still are not in play unless you're operating a trader business on those properties, the land and the building. But I would look at this at a 60-40 structure as the limit for right now until we get further guidance.
And then maybe just one final question that I think is a good wrap-up question. There's a general interest in understanding, if you're running an opportunity zone business, or if you're interested in investing in an opportunity fund, or if you are a city or other municipality that is trying to manage this program and wants to attract investment, what's the best way to get in touch with investors, for businesses to get in touch with funds, for investors to get in touch with funds, for cities to get in touch with all of the above? How do we get folks together?
Well, we are building out something for that purpose right now. I'm hesitant to say more because it's literally in process, but we're very aware of that because we're getting that question a lot. So from our perspective at ACA, I would say stay tuned. I mean, literally we're working on it. I'm going to a meeting on it almost directly after I come out of here because it is a little bit complex. This is not like, well, almost anything else where there's a list of these are the people who are raising funds. These are the people who are qualified investors. These are the projects. That doesn't exist. And we're looking very much at what to do about that. Really and truly stay tuned because we're going to let you guys know in the next few months. But what would you say, because you're seeing this on more of a national level?
Yeah, so there are a number of conferences, and so those are good to go to because you'll meet, folks with projects, you'll meet investors, and you'll meet folks who are forming or who have formed funds. But it all comes down to networking, and so the more events that we do here locally, the easier it is to bring people together.
And we will continue to do that. I mean, we wanted to just get a call quickly together because this guidance is something we've all been waiting for so long. And I have been saying, I don't know, we need the guidance. I don't know, we need the guidance for like 10 months now. And now we have the guidance, and we felt like our first obligation was to try to share some of the bloody nitty-gritty details of that guidance with you all so that things can start to move. But we definitely know there's the need for networking. There's the need for conversations with folks who are operating at the city level, folks who own property or businesses in the zone, people who are getting ready to liquidate investments, who want to make sure they're doing the right thing, whether they want to start their own fund or go into someone else's. We want to be able to showcase the funds that are raising money and investing here. It's coming, I promise.
Yeah, I mean, it is a complex program, and the guidance, what it did do for us is that it did provide it provided some certainty at the investor level. And we still have questions. So you got the three levels, right? You got the investors, you got the funds, and then you got the businesses. So we still have a lot of questions at the fund level. We answered some of them, and then we have quite a few questions at the business level. I mean, ultimately, when you speak with the folks over at Economic Innovation Group, they see this as a program to finance operating businesses. And so we are still lacking a lot of guidance with respect to operating businesses. I mean, startup businesses are a lot easier to finance with this than expanding, current, operating businesses that are in the opportunity zone right now. And so, eventually, again, this is just a first step by Treasury, and they have another reg project opened up. If you look on, I think it's, what is it, I forgot which, maybe it's the OMB site. It talks about the second reg project. And so we'll be seeing, I expect to see additional regs either later this year or early next year. And so this is a process, but it's a good first step.
Well, I think that's covers the bulk of the questions that were asked. If there are additional questions, please feel free to reach out to Sean or Mark. We'll make these presentations available. And hopefully there will be much more to come as it relates to further regulation and further resources from the Commerce Authority. Thank you so much.
Thank you.
Thank you.